China and Europe, they cut rates last week, but the market had sort of a muted reaction to that. What's going on?
Well, I think it's because a lot of the economic data that's coming out in these areas, including ourselves, has been really weak, a lot weaker than expected. So people are wondering, do the numbers have to get materially worse and then more aggressive actions need to take place? How do you transition between the two, really? And I think that's why the market has kind of been in this trading range.
Yeah, and even with China, the inflation number came out this weekend and it was lighter than expected. And even though the government's out there and they're clearly cutting rates and being aggressive there, it seems like the investors are more worried about the situation over there.
Right, now you have concerns about deflation and that kind of situation. I think you just have to step back and say, you're either going to day trade this market or you have to look for the opportunities. And it's hard to just own kind of the cyclical companies, right? Like materials and energy and industrials in this kind of environment. But, where there are companies that have good dividend yields and dividend growth and strong balance sheets, if you can take a longer term perspective, I think you have to be nibbling at those sectors. And then what we've been doing is just complementing it with some of the defensive names too. Some of the staples, some of the healthcare, those kinds of things, so that at least you're somewhat protected on the downside, and that you also participate in these, pretty monster rallies.
Are there any specific stocks that you like that have a greater presence in Europe or China?
Well, yeah, I would definitely lean towards more China versus Europe. I think Europe is going to be structurally challenged for a long time.
Right.
I think China, there's still growth there, right? I mean, even if you're growing 6-7%, it's still pretty healthy growth. So, I think that we've been focusing on something like a McDonald's or something like a Nike. But at the flip side, I look at a DuPont, I look at an Eaton, and again, they have really good dividend yields at this point. And so while you wait, you get at least paid, and again, you have a diversified portfolio.
And what part of your portfolio needs to be in domestic names?
Well, that's a good question. I would say, maybe the 70-80%. However, that said, a lot of that theme has already played out, right? A lot of people talking just invest in the U.S. So that's why I think going and looking at opportunities where there's exposure in China, even in Latin America, in Brazil, I think that there's some interesting opportunities. Europe is one that an area that I just would stay away from. But you know what? That said, Lindsay, we have plenty of stocks, unfortunately, that have exposure over there. So, should you get a stabilization, we'll certainly participate.
This market is
stock tickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to